Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We begin in Japan, where the inflation rate ticked up in the month of October. Consumer prices, excluding fresh food, rose at a rate of 3% compared to last year. Now, that may keep the Bank of Japan on track for an interest rate hike in the coming months. And at the same time, this inflation print comes as newly installed Prime Minister Takaichi is planning to unveil her first economic package later today. Now, she's already vowed to address the frustration over persistent increases in the cost of living. For a closer look now, I'm joined by Masa Takeda. He is portfolio manager at the Hennessy Japan Fund. Masa, thank you so much for making time to chat with me. I'd like to begin with the inflation story vis-a-vis Takaichi and whether anything that she rolls out today has the potential to change the inflation story in Japan. Does it?
In terms of impacting inflation, I think it still remains to be seen. I think Takaichi is largely known for, thus far, her more proactive fiscal policy and dovish stance on monetary policy. So if anything, there might be inflationary side effects, but it'll take time whether that is going to be the case or not. Short term, I think it's more stimulative to the economy, and I think that has been the main focus on the market.
One of the culprits in the inflation story in Japan has been the weakness of the currency. Right now, the yen is trading against the dollar with a 157 handle. Yeah, a portion of that weakness could be addressed through a rate hike from the Bank of Japan. There's also the possibility here, Masa, of intervention from the Ministry of Finance, correct?
I mean, the yen has been weak, for good reason, which is the real interest rate of Japan is deeply negative, and I think the yen is pretty much the only currency among major economies with negative real interest rate. That inevitably it pushes up import prices. Now, whether the central bank is going to hike rates or not, the timing is uncertain. However, I think it's still on a path towards gradual rate hikes. I say gradual is because the Bank of Japan has made some mistakes in the past, 2000 and 2006, when they prematurely lifted, the zero rate policy, and each time the economy fell into recession. So I think they're going to, rather gradually hike rates going forward.
I'm curious to get your take on this recent spike in tension between Tokyo and Beijing, given the recent comments from Prime Minister Takaichi on the issue of Taiwan. This is clearly deepening the rift between Japan and China, and I would think that it carries with it a lot of severe economic implications, many of which could be substantial.
Well, so of course, at the top level, there are tensions right now, but it's not the first time, and I think the Japan and China always manage to work out those frictions. And on a more micro level, we do see the Chinese consumers always wanting to buy Japanese products and the high quality products and the services, not to mention the inbound tourism. Currently, some restrictions that may result in slowdown, but I think eventually, the Chinese consumers will behave according to what they want. So I'm not too worried about these short-term events.
It's been a pretty amazing year for the Japanese equity market. Yes, the Nikkei is down from record highs. Nonetheless, I think in dollar terms, the Nikkei is up by more than 20%. Are you constructive on the Japanese equity market?
So short term, as you said, the market has been up quite steadily since the beginning of this year, and that's basically a function of re-rating of the valuation multiples, and therefore, short term, the return expectations might be more limited for the foreseeable future. However, I am still very positive on the mid to long-term outlook of Japan, and that's because not just the improving economic fundamentals, the rising inflation and normalization of interest rates, but I think the most important driving force is the corporate governance reforms. And it's been going on for about 10 years now. And, finally, corporate Japan is embracing the basic principles of Western capitalism. So the capital efficiency has been steadily improving. And now, the last few years, the main focus was on companies whose share prices were trading less than 1 times book, so the corporate underperformance. But now going forward, the market regulators and the government are now reviewing the current existing corporate governance code to deliver a stronger message to those that are trading above 1 times book, because the capital allocation is not always optimal at those companies as well. So that's the one key catalyst to watch out for.
And how are you feeling about the trade relationship between the U.S. and Japan right now, with higher tariffs and the impact they represent to Japanese exporters?
Japan had trade deficit with the rest of the world, but with the U.S. had trade surplus, and that was mainly with car makers and auto parts suppliers. These companies are now, through internal rationalization, absorb most, if not all, of the impact from the tariffs. Meanwhile, I think there's also kind of positive development in terms of foreign direct investment by Japan into the U.S. $550 billion, worth of foreign direct investments promised by the Japanese government that should take place over the next, 4 years before Trump leaves the office. And so there's increasing economic, cooperation between the two countries, and that should benefit some of the Japanese exporters, whether it's semiconductor, AI, or others. There are mixed signals, but I think I'm leaning towards more positive outlook for these exporters. Okay,
Masa, before I let you go, I have to ask about what your expectations are for the Bank of Japan when it comes to the December meeting, and whether or not you think the BOJ will hike interest rates.
Well, so short-term outlook, my prediction is just as good as anyone's on the street. But as I said, I think that Japan is on a path towards gradual rate hikes. And what that means is that the nominal rates will rise while the real rates will likely remain negative or very low at most. That means the monetary policy overall framework will likely remain accommodative. And that should favor asset classes like equities. So higher nominal rates should definitely further improve the fundamentals of financials, banks, financial services companies, insurance, and so on. And then the broader accommodative monetary policy should benefit the broader market also. I think the current environment is very favorable.
Masa, we'll leave it there. Thank you so very much. Masa Takeda, he is a portfolio manager at the Hennessy Japan Fund, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We had a dramatic reversal today in the U.S. equity market. The session began on a big up note after those surprisingly strong results from Nvidia, and at the New York Open, Nvidia popped 5%, and that led the S&P to a gain almost immediately of about 1.9%. But by midday, those gains began to steadily evaporate, and at the end of the session, the S&P was down by more than 1.5%. For a closer look at the price action, I'm joined by Adam Coons. He is the CO-CIO at Winthrop Capital Management. Adam, thank you for making the time. Let's begin with getting your view on today's trading, especially that reversal.
Well, obviously, it's a little bit shocking to see, almost a 4% total move in something like the NASDAQ for the day. And this is really kind of that exhaustion that you're feeling in the market, especially heading into year end, where you cannot forget the fact that the market, like the S&P 500, has been up, 20% for the last 3 years in a row. And this is coming off of, quite a volatile springtime when the S&P was down, over 10%, recovered it really quickly. And then we're off to the races again. It seems like everyone just kind of forgets tariffs, inflation, everything else that's kind of been in the headlines, and it's worked. But I'm not really surprised that, you're continuing to see markets start to ask more questions. And that's really what's happening is, the markets are starting to think through the AI story, some of the private credit issues that we're seeing in different pockets here in the U.S. And it's just giving investors a little bit of a, more cautious attitude anytime you see a rally. And that's probably what we're going to see for the rest of the year, is that when we see big rallies, we might see just kind of sell the news type mentality for the rest of the year.
Did you hear anything from Nvidia after the bell on Wednesday that may have justified this type of skittishness on the AI trade? I thought it was very interesting. We heard from analyst Kim Forrest over at Boca Capital Partners, and she was saying the market may have been spooked a bit by Nvidia's rising net accounts receivables. To quote Kim, if your chips are flying off the shelves, why aren't you getting paid for it? Do you think that's a part of the narrative here when it comes to Nvidia, that we must take a closer look on what's really driving revenue and profits for this company?
Yeah, I mean, I think we've entered that phase of the market where investors are actually going to start taking a look and not just taking your word for it. Like you said, you're seeing accounts receivable pick up, inventories are picking up at the same time when management is saying you're sold out of chips. That raises a lot of red flags that have already kind of started to percolate with investors that are trying to understand this circular nature of kind of the AI story, selling, leasing, and kind of what is really driving revenue. Is it just companies selling to themselves? And so, yeah, that is a big part of what we saw today. Just that, further digestion of how is this really working? Who's really making the money, and who's really going to pay the price down the road?
I'm also wondering about the degree to which the Fed is a part of this story. We had some pretty hawkish Fed speak today. We heard from Governor Barr as well as Fed Bank Presidents Goolsbee and Hammack. And in aggregate, there seems to be a lot of concern about inflation, in spite of the fact that the labor market continues to struggle. And I'm wondering, Adam, is putting greater emphasis on the inflation story justified?
In the short term, probably, but in the long term, no. And I think you saw the bond market eventually come to grips with that, because by the end of the U.S. session, you had rates start to come down pretty much across the entire curve. But yes, there was a period there where some of the Fed, minutes were coming out, and the thought around that was pushing rates up. But like I said, by the end of the day, I think most investors started to think through the jobs number, the fact that the jobs market is still, I don't want to say weak, but is fragile. And at the same time, just the overall economy coming into question. So, it's going to be difficult as we start to get numbers that are a little bit discombobulated with, the timing because of the U.S. shutdown. What we really saw by the end of the day was just a pure risk off, and less worry about inflation and more worry about the U.S. economy.
Speaking of fragility, let's talk a little bit about the crypto space. The sell-off in Bitcoin continued. I think we've been in retreat now for more than a month. Today, Bitcoin fell below 87,000 for the first time since April. A number of analysts were saying crypto is no longer the canary in the coal mine. It's the coal mine itself, and it's collapsing under the weight of its own leverage. I was struck by the fact that according to CoinGlass, the forced liquidations over the past 24 hours totaled $847 million. Adam, I'm curious to know how you understand Bitcoin as a part of this risk-off move.
I see it as a symptom of the cold. I think you've got just a general, like I said, risk-off mentality, and it's being exaggerated because Bitcoin, any crypto for that matter, is already volatile. You match that with, like you said, the increased volatility that comes from a time period where you start to get margin calls. And so I think that's largely what's, kind of driven the acceleration of the decline. And so as any investor in the crypto space, I think you've got to be really careful right now. We need basically see all of these, just all the leverage in this space. At least I want to call it, kind of the weak leverage, those that just are way over their skis. You got to let that kind of work its way out of the market. I don't think this is the end of the crypto trade by any means. We're just kind of entering that just higher volatility period that people tend to forget when times are good.
So given everything that we're talking about, I'm curious as to how you play the market right now. Are you a little risk averse? Are you storing away a little bit of dry powder? Are you waiting for a further pullback in risk assets? I mean, what's your strategy right now?
Obviously, where you're coming from matters a lot. So in probably the last half of the year, we've been more defensive, generally speaking. So for us, that gives us, it's difficult when markets are going up and you're defensive, but we look for times like this because this has actually been our opportunity to shift more towards neutral. And that's not a very exciting thing to say, but when you're coming off of being maybe underweight some certain sectors, some growth sectors, that sort of thing, for us, when you do have dry powder, when you start to see these market dislocations, that's actually the time to put money to work, to put money, to risk a little bit. Now, we're doing it very, very marginally because I think there's still probably the higher risk is to the downside, I'll say that. But we are starting to kind of rebalance and reallocate towards neutral, which is actually increasing our allocation to risk right now. And I'm happy to do that. I'm kind of happy to sit neutral going into year end because I don't have a high conviction in any particular large sector heading into year end.
Okay, Adam, we'll leave it there. Thank you so very much. Adam Coons is co-CIO at Winthrop Capital Management, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.